The Houthi rebels are attacking key Saudi oil facilities again, and we're going to see an escalation in oil prices, an escalation in the Middle East war, and I'm going to get into explaining as to why are the Houthi rebels bombing Saudi key oil facilities, and also a number of factors of why oil prices will continue to rise. I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe. Behind me here, you could see footage of the Saudi Aramco storage petroleum facility in Saudi Arabia that's been bombed by Houthi rebels' drone attacks. Okay, and so Yemen rebels strike oil depot in Saudi city hosting F1 race. Yemen's Houthi rebels attacked an oil depot on Friday in the Saudi city of Jeddah. It was the rebels' highest profile assault yet. The attack targeted the same fuel depot that the Houthis attacked in recent days. In Yemen, Saudi Arabia leads a coalition battling the Iran-backed Houthis who seized Yemen's capital of Sana'a in September 2014. The kingdom, which entered the war in 2015, has been internationally criticized for airstrikes that have killed scores of civilians, something the Houthis point to as they launch drones, missiles, and mortars into the kingdom. So here's the deal. Saudi Arabia and Iran have been at war in Yemen since 2014. Okay, and so the kingdom is dropping bombs and killing scores of civilians. Okay, and so this is Houthis' excuse to go in and drop bombs in Saudi Arabia. But we know that the Houthi rebels are simply trying to cause havoc on a world stage, trying to get world recognition, because nobody cares if Saudi Arabia or the Houthi rebels drop bombs in Yemen. But if you attack a key oil facility causing oil prices to go, you get public notary. Everybody knows who you are at that point, and they're simply trying to attack the American economy. And the only way to do that is to cause oil prices to go up. Putin and the Houthi rebels work together. Okay. And so everything that they do bodes well for one another, and both want oil prices to rise more than anything. And Saudi Arabia, as Russia loses their contracts, Saudi Arabia is fulfilling them. And so as Putin loses contracts because of these strict sanctions due to him going into Ukraine and attacking them, he's losing contracts, and Saudi Arabia is replacing him. Okay. And there was a time when Saudi Arabia and Russia went toe-to-toe and said, you know what, I don't agree to your demands as far as curbing production. OPEC is the conglomerate of all the oil producing countries in the Middle East. Okay. OPEC plus is the plus sign simply means Russia. So OPEC plus came together to curb production. They all agreed, hey, I'll reduce my output by 1 million barrels a day. You reduce your output by 2 million. And they came to an agreement. Well, Russia was not sticking to their agreements. And so they said, you know what I'm going to do? I'm going to flood the market with oil and I'm going to bankrupt you. And Saudi Arabia said, fine, I'll do the same thing. They flooded the market. Oil prices went to negative for the first time ever. And Russia and Saudi Arabia went to attack each other. And then now they've been competing for market share. They've been competing for contracts. And now as Putin is attacking Ukraine, he's getting sanctioned to death, and now here's Saudi Arabia stealing his contracts. So that pisses him off, okay? And so he uses the Houthi rebels to get back at him to destroy their oil facilities, okay? And so the higher oil prices go, it bodes well for Russia, it bodes well for Iran, it bodes well for all of OPEC, okay? And so this hostile escalation targets oil facilities and aims to undermine energy security and the backbone of a global economy. British Prime Minister Boris Johnson condemned the Houthi attacks on Twitter. These strikes put civilian lives at risk and must stop, he wrote. So after the bombs were dropped, the Houthi military spokesman sent a video out to the world, telling the world this was in fact the Houthi rebels. On the 8th anniversary of our alliance, the Yemeni armed forces carried out the third break the blockade operation by launching several attacks with drones and ballistic missiles. against the Aramco installation in Jeddah and vital installation in Riyadh. So they're not going to stop there, guys. Listen, this is a war between Iran and Saudi Arabia. Okay. And so the Houthi rebels are going to continue to keep dropping bombs on key oil facilities in Saudi Arabia. They're going to hit them where it hurts them the worst. And so right now, oil price, WTI crude is trading at 112.60 cents a barrel, 119.50 for Brent crude. Oil prices bolstered by falling crude inventories. Crude oil prices continued up today after the Energy Information Administration reported a crude oil inventory draw of 2.5 million barrels for the week to March 18th. And so simply what that means is that we are drawing oil from crude inventories versus increasing oil inventories. When we were producing 13 million barrels a day during the days of Trump, because we had the shale revolution, we were increasing oil inventories every single day. Rarely there'd be a draw. That caused an oil glut. And so over time, that glut went away, and that's why oil prices came back. That's why oil prices dropped down to $30 to $50 a barrel, because we had a major oil glut. Well, now we're using more oil than we are producing, okay? So I want you to read this article that was sent to me by my geologist, Kevin Fowler, warning of $200 a barrel of oil. Okay, now this is by analysts that know more about the oil and gas industry than any random person that just randomly speculates $200 oil. I mean, this is based upon evidence, facts, data, information. And so I wouldn't normally just read an article like this about $200 a barrel, because normally it's just clickbait. But the growing boycott of Russian oil and the lack of spare production capacity elsewhere could send crude prices above $200 a barrel, energy industry experts have told the Financial Times. A top energy trader said sanctions on Russia will remain even after the war in Ukraine ends. I think we are losing the Russian supply on the European side forever. He predicts the price of oil could double to $250 a barrel this year. A view shared by Doug King, chair of RCMA's Merchant Commodity Fund. This is not transitionary, said King. Okay, and so there's many people agreeing with this. Russia is the world's second largest crude exporter, behind Saudi Arabia. Analysts estimate that up to 3 million barrels a day of Russia oil could disappear from the market. The U.S. shale oil industry can't ride to the rescue. Footnotes, because producers will need 12 to 18 months to significantly boost output. Okay. We are in a situation where Russia's oil, if it's taken off the market, it's going to reduce 3 million barrels a day of oil exports. Okay. We're not talking about just production. We're talking about 3 million barrels a day of exports. Oil that is needed in order to maintain oil stability. Okay. That is going to increase oil prices substantially. The U.S. shale oil industry can't ride to the rescue. All right. And so there has not been enough money spent on oil development. Many rigs have been taken offline. Many oil companies have gone out of business, and it's going to take 12 to 18 months to make up for the loss of time. Okay. If they were producing, oil prices would probably be more like $70, $80 a barrel. But I'm telling you right now, it's going to take 12 to 18 months to catch up. Not only that, the demand for oil is increasing. That demand is growing. And everyone said, oh, green's going to fix the problem. Well, it hasn't. And so all of these investment funds who are listening to Generation Z, the younger generation, are the ones that are like wanting Bitcoin. They want green tech. They want all these different things. And as where the older gents, the ones that believe in fossil fuels, they're sitting on their hands because they don't know what to expect. Okay, here we are. That put us in this situation. Oil and gas underinvestment's the worst it's ever been. We can't catch up at this point, and everything that's happening, I mean, geez, it's going to get worse, guys. This is incredible. Oil Energy Insider, they send me emails, and it's they have an incredible breakdown as far as where the market is heading here. And so Putin threatened European gas imports. A storm knocked a major oil pipeline offline, and Saudi oil terminal came under missile attack. Brent is back above $120 per barrel as bullish sentiment remains dominant, but plenty of bearish factors are still looming. Right here, U.S. oil production. Okay, so this dashed line represents us today, 2022. The blue line represents the U.S. oil production in 2021. And orange is for 2020, gray is for 2019, and the red is 2017. And so it shows here in 2017, we went in January, we went from 9 million barrels a day and grew to upwards of 10 million barrels a day. Okay, that's the highest, all right? In 2019, the gray section, we went from 12 million and rose to as high as just under 13 million, okay? And that was the peak as far as U.S. oil production. And here in orange, we went from a flat just under 13 million a day, and we dropped down to as low as 10 million, okay? This was COVID and everything else that's been happening, okay? And so this is where we are today, just under 12 million barrels a day, so it's flat, okay? Now, here's the deal. That growth from 9 million to 10 million barrels a day in 2017, and we went from just under 9 million barrels a day in 2017, and we reached in 2019 to just under 13 million a day. Okay, that huge amount of growth was because they were spending hundreds of billions of dollars of capital a year in oil and gas. That ain't happening right now. Banks are not funding the shale industry. And in order to maintain this high right here, we have to drill a lot of shale. You got to understand something. A shale well might come online around 1,000 barrels a day, but it'll decline massively. So in order to maintain this 13 million a day, we got to drill like crazy. That's not happening today, guys. This number is going to continue to decline in 2022. Okay. And so crude oil futures continue to rise as far as contracts. That's what they're gambling on and expecting oil prices to go. This is crude oil stocks right here. Okay. And so in March 19th, 2021, our crude stocks were at 502 million barrels. Okay. And so as you can see here, at the start of February 2022, we were at 410 million. And now we're at 413 million as far as crude stocks. And so we've dropped about 90 million barrels of oil in crude stocks. And this crude, I'm talking about actual barrels of oil being held. Okay, these are the stocks, they're being held. And so this is companies across the board. Chevron, all the majors, all the major oil companies, the refineries, they have stocks of oil, and the amount of oil in these stocks, it determines how much oil we're using and how much oil we're producing. And so if we are not increasing in oil stocks, that means we're producing enough oil to meet with demand. But if we're drawing down oil stocks, that means we're not producing enough oil to meet with demand. Demand is higher than how much we have in reserves. So bottom line, what this chart shows us is we're using more oil than we're producing. Okay, so we need more production. That number is only going to get lower. Right now, we're at 413 million barrels from 502 million back in 2021. And so here's a chart that makes it more clear. U.S. crude oil stocks, we go from 540 million September 2020, and we continue to decline to March 2022, under 420 million barrels. Okay. And so U.S. refinery runs are increasing. And so a refinery run simply means that we're sending crude oil to convert the crude oil to gasoline, to plastic, to different, to propane, to different kinds of fuel sources and what have you. And so from February 4th to March 18th, we're using a lot more crude oil, as we are running it through the refiners. So we went from 12.5 million in March 19th, 2021 to 15.5 million in March 18th, 2021. Okay, 2022. So crude oil imports have increased. We went from 5.6 million in March 19th, 2021 to 6.5 million in 2022. Gasoline prices have increased. As you can see here, we're at $2.80 in 2021. Now we're at $4.20. Okay. The beauty of the oil market lies in how unpredictable it is. The big story of this week is storms damaging export facilities. Flagship 1.2 million barrels a day grade was expected to drag oil prices down on Friday when loadings restarted. Just as it seemed that Brent could move lower from the 120 per barrel mark, the specter of Saudi supply disruption reappeared with an oil storage facility taking a missile hit in Jeddah, presumably from Yemen's Houthi militias, coupled with the dormant Iranian nuclear deal and incessant European quarreling about the right way to sanction Russia. Not even a coal embargo could be agreed upon, predicting the movement of the oil market is only getting harder. Okay. U.S. clinches new LNG supply deal with Europe. U.S. producers will seek to supply 15 billion cubic meters of LNG to European Union in 2022 as a means of weaning the continent of Russian gas dependence. Now, here's the deal. Russia's one of their biggest clients is Europe, and to undermine them by us selling LNG directly to Europe is a huge slap to Russian faces. Gas that we send to Europe, the less we have. That's replacing Russian exports, okay? And Russian exports will be replaced. Russia cannot sell the gas to anybody else, okay? That was a huge contract that they lost. And so now we're replacing with American LNG. That bodes well for America, and it allows us to produce even more natural gas. And the biggest production of natural gas comes from shale. That's why our gas prices are cheap here as far as heating our homes and what have you. But here's the deal. It allows us to drill even more without affecting oil prices, okay? Because we're selling it, we're exporting it. Okay, and so Caspian terminal outages turns up the differential heat. Europe's largest light sweet crude stream, the 1.2 million barrels a day CPC that incorporates most Kazakhstan's production, saw its outflows curbed dramatically this week after a storm reportedly damaged 2 of the 3 berths of the CPC export terminals. So natural disasters are reducing the amount of oil production, okay? OPEC expresses concern at the European-Russian embargo threat. According to media reports, OPEC officials have informed the European Union that a possible EU ban on Russian oil would hurt consumers and advised against it, indicating that Riyadh and Abu Dhabi want to keep the OPEC Plus group alive. Floating mines will make Black Sea shipping high risk. Shipping insurance companies have urged clients operating in the northwestern part of the Black Sea to be wary of floating mines reportedly drifting south after they broke loose from their tethers in Ukrainian ports. Okay, and so these floating mines are going to destroy shipping oil tankers. All right, and so listen, the more expensive it gets to export oil, the more expensive oil is going to be. And listen, people don't want cruising around with mines in the ocean. I wouldn't want to have that job. Dutch ING to end financing of oil and gas project. Dutch bank ING announced it would no longer finance oil and gas projects, the largest bank to have done so thus far, adding that it would concurrently target a 50% increase in lending for renewable energy projects by 2021. You'd think they would have already learned that green technology cannot fix the energy crisis that we're into and lower the demand of oil. Listen, that is a very stupid move, and this is a lot of banks are doing this, and it's only going to get worse, guys. So the less we fund oil and gas deals, the more oil prices will rise. U.S. starts buying up Middle Eastern fuel oil. U.S. refiners have started mopping up Middle Eastern fuel oil cargoes as a way of supplanting sanctioned Russian flows with 4 million barrels from Saudi Arabia, Kuwait, and Iraq set to arrive in the U.S. Gulf Coast next month, a third of the 2021 total. So bottom line, they're buying Middle Eastern fuel oil to replace Russian oil. Yet another contract that Russia is losing. Indigenous Australians took this Santos-led $3.6 billion Barossa gas project in an offshore Australian to a South Korean court, asking the project's South Korean lenders to block loans due to the field's adverse environmental impact on wildlife. Okay, and so there's a lot of people suing oil companies, trying to destroy the oil and gas industry, thinking that this is going to help the world, to save the world. And so we're in this situation because there's a lot of green idiots out there. Banks are not financing. Russia's bombing Europe. Houthi rebels are bombing key Saudi oil facilities. Iran and Saudi Arabia are at war. I don't see any end in sight to that. The banks are stopping the financing of oil and gas. Guys, I'm telling you, man, it is the Wild West for the oil and gas industry. I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe, and we'll talk soon. Thanks.